I often get asked about loan assumptions. And so, what is a loan assumption? A loan assumption is when somebody's selling a house and they have a loan on it, and that loan has a provision that the buyer can potentially take over the payments on the loan. Now, that sounds great, but the opportunities for these are extremely rare. And even on homes where loan assumptions are being offered, more often than not, they're very difficult to get into. And here's what you have to consider with a assumable loan. Number one, it's going to be a VA or an FHA loan. Conventional financing does not allow for loan assumptions. Number two is you have to come in with the difference between the seller's asking price and the loan balance. So for example, if that buyer or if that seller has been in that loan 5 or 6 years, they've probably seen a pretty good amount of appreciation. I had a client recently, the asking price was $425,000. The assumable loan was $140,000. And while that assumable loan had a great interest rate, she didn't have $280,000 to put down. She had a pretty significant amount to put down, but not enough to cover $280,000. And while there is secondary financing available, you then have to qualify for not only the loan assumption, but the secondary financing at the same time. In her case, that wasn't going to happen. So one thing to consider when you're looking at something that's advertising an assumable loan is, what is the current balance versus the asking price? And can you come in with a difference or find secondary financing in order to make up that difference? Chances are probably not, unless it's a VA loan that was taken out recently. I hope that helps, and have a great day.